Sorry, good afternoon, 12:01. My name's Jason Husky, Head of Industry Trade. And wider New Zealand market as well. For those of you that have attended our events in the past, you'll know that we do a lot of work with Brad. He's possibly the youngest looking serious person I know, and I think also always presents the economic update in a way we can all sort of digest and understand. So without further ado, I'll hand it over to Brad Olsen to give us all an update. Welcome, Brad.
Awesome. Well, thank you very much for that. It's great to be here and provide a bit of insight into what we're seeing out there in the market at the moment. I mean, my goodness, the economy seems to keep shifting all the time, and wanted to bring with today a little bit of insight both into what we're seeing in the general economy, but also some specifics about the Bay of Plenty region as we go forward. There's a lot of similarities that we're seeing in different parts of the economy. There's a lot of important drivers nationally that I think everyone needs to sort of have a bit of insight into, but useful as well to get into some of that nitty gritty and seeing what we're seeing at that more local level. So without further ado, we'll do some Q&A towards the end, but for the moment, let's get going with the presentation itself. First and foremost is where we're seeing interest rates and what the Reserve Bank is doing. Of course, that does have a pretty big impact on the economy, both outright economic activity, spending and investment and everything else, but also sort of people's expectations for what's happening in the economy, their sort of reliability about how things are going to progress in the future. The Reserve Bank's been pretty clear. They think that there needs to be a bit more stimulus into the economy, and so they've done a bit more of that with a 50 basis point cut to the official cash rate recently, taking it down to 2.25%. Expectations are still pretty strong at the moment that there'll be a further cut to the official cash rate down to 2.25% later in November. But if the feeling is that the New Zealand economy needs a bit of defib action, needs a bit of support in the near term, you don't normally use the defibrillator for the entirety of 5 years into the future if you need a bit of a shock. And so you can see on our forecasts at Infometrics, we expect the official cash rate after stimulating the economy to then need to move back to more of a neutral position around that sort of 3% mark from the start of 2027 onwards. Effectively, that's because if you do get the economy going, well, clearly things will have been stimulated enough and it should be able to carry on. Of course, that expectation, though, into the future is that there could be some challenges coming out the other side. And so you can see on this forecast chart our expectation of the potential upside risk to interest rates. So you can see there the potential for the official cash rate to have to get up to 4%. Now, that's not the central view, but let me talk you through why we're a little bit worried or at least cautious about that thinking and what it means for the future. At the moment, interest rate cuts that we've made in the last month or so aren't going to fully impact the economy for really the next sort of 6 to 12 months. It takes that long for everyone to refix their mortgage and everything else and move through. So in our minds, there's a risk that interest rate cuts that we've been making recently don't really hit until, say, October next year, at which point the economic recovery might already be getting going. Inflation might be too hot, and again, we might need to do a little bit more to really restrict the economy from overheating. Remember, this is exactly where we've been before. 2021 or so, economic activity was starting to improve. We continued to cut interest rates, provide stimulus through to the economy and similar, and therefore overdid it and needed to correct ourselves with those interest rate hikes in more recent times. At the moment, you'd get the feeling that the economy is not in a strong enough place to be pushing through, larger and larger price gains, and so that would allow interest rates to remain lower. But of course, we've also got 3% headline inflation. So there is that question of, again, in the future, do you see the same level of interest rates? Do you see the same level of stimulation, or do we need to restrict things a bit more as we head into the future? At the moment, we know that headline inflation has crept to the top of the Reserve Bank's band. It's currently sitting at 3%. If you want to take it to, I think, 2 decimal places, at 3.04. So it's technically outside the Reserve Bank's band. Now, at the same time, that is expected to be a little bit more short-lived. That's an expectation. I've just highlighted the risk or the worry, but the central expectation you can see on the light blue line here is that headline inflation then pulls back to more around that 2% mark from the middle of next year. Businesses aren't seeing the greatest economic times. They're not able to lift prices to quite the same degree. And you can see all the other economic figures here, the various sort of core inflation metrics showing that headline inflation is expected to pull back because those core pieces aren't moving up quite as much. Now, that's all good and well for an economist to tell you that theoretically inflation is in a better spot. Most households, though, are of course grappling with the likes of higher food prices, higher, local government rates, higher energy costs, and similar. So there's a little bit of, I think, caution or concern about the number of high frequency, often bought essential necessity costs that are continuing to go up for households. That again just gives us a little bit of pause for thought around the challenges that households are grappling with. One of the better economic indicators, though, recently is that we have seen a very slow but concerted effort to see a turnaround in job ad numbers. Now, you have to look pretty close to start to see the job ad numbers coming through here, but there have been 3 months in a row where job ads have lifted month on month. So there is a gradual sort of trend starting to emerge. It's not quick by any stretch of the imagination, but it is starting to show forward. And certainly on our numbers and expectations, we do see that those improving job aspects do start to provide a bit more of a boost to households. There's been a little bit of a standoff this year. Households have been sitting there, they've been getting lower mortgage rates, but they haven't necessarily been spending quite as much. Households going, well, look, I'm not going to spend heaps until I'm a bit more confident about the jobs market. I know unemployment's high. I know it's going to be tough to find a new job if something happened. And so instead, people have been holding on to their money. At the same time, businesses have been sitting there and going, well, I'm not going to hire anyone else until I see better spending numbers. And so I'm going to restrict my hiring, which means that households aren't spending. And so it was a little bit of a vicious circle. Now that a bit more money is starting to come through into the economy, it's taking a while, but you are starting to see those job ad numbers lift, albeit from pretty low, a low starting point there. If we look at what the jobs market's doing more locally, here's the sort of change in job numbers for the September 2025 quarter for the Bay of Plenty compared to a year ago. You look at the top, those areas that are growing. Health, well, of course, there's a larger population, both nationally but also in the Bay of Plenty, alongside, of course, an older population, which requires more services, so a bit more population-led growth there. Better primary sector outcomes coming through. We've seen a very strong crop coming through in terms of kiwi fruit, apples as well. I think there's been something like a 26% increase in the volume of apples that have been coming forward. So again, horticulture, general primary sector in a better spot, providing a bit more employment. A little bit more tourism-y travel from some international visitors, adding to arts and recreation. Again, a bit more population coming through from education, and then a few other bits and pieces through. At the other end of the spectrum, there has been a pullback in construction as the sector tries to size itself after some bigger years recently, trying to figure out where the Goldilocks zone is. Again, a lot of pressure on manufacturing, especially from higher energy prices recently, and then declines in some other industries too. Your trade areas, retail and wholesale, a little bit less on the professional services as well as businesses try and contain costs. So importantly, look, it's a mixed view here, but it's not like every part of the economy locally is in decline. Also, not every part is in expansion. So a little bit more through the middle. Coming back to that manufacturing point, you can see the challenges more recently where manufacturing, the dark blue, had been declining for about 2 years in a row up until the start of 2025. Then we came through to this year, a little bit more new order purchasing going on from manufacturers, businesses across the country wanting to get a little bit ahead of that potential economic wind-up, not wanting to sort of be left behind and not have enough stock. But then came the tariffs, a little bit more of a pullback in new ordering because people were a little bit worried, weren't sure what was going on, everything was uncertain, and everyone started to sit on their hands. You can see the last couple of months, a little bit more of a bobber, a good month here and there, a little bit more average, a little bit below average in the last wee while, and a similar sort of trend for services. Again, not firing on all cylinders by any stretch of the imagination, but starting to trend in a slightly better, more consistently upward or improving at least sort of position. Part of the challenge is that households have still been fairly downbeat in recent times, or at least not upbeat. And I guess that is a little bit of a difference. You can see on this chart coming from the One News Varian poll, most people look at the Varian poll, the old Colmar Brunton, for the political analysis, but we look at it from an economic view. This poll's been going since 1974, so it gives us a good insight into how households are feeling. And you'll see that up until October, most households were thinking that the economy was going to be either improving or more likely staying the same in 12 months' time. So not necessarily that people thought things were going to become tougher, but also not that strong of an expectation that things were going to absolutely bounce away. It was just a bit more of the same. In fact, you had to go back to the 1980s, 1981, to see such a long stretch of people expecting the same sort of economic outcome. So we did feel like we were just a little bit in a holding pattern. In more recent times, October, you saw that bad GDP result come out in September, down 0.9%. I think that sort of put a bit of a shock into the system for households, and then you sort of saw that jump in people expecting worse economic times. I think realistically, looking through some of the economic numbers, the June quarter probably wasn't as bad as the headline GDP result implied. It's probably more likely that it wasn't quite as bad, but the rest of the year again might not be quite as good as that recovery that we eventually see published. So, long story short, keep your wits about you on the GDP front. Where's this all of this leading? Well, you've seen a real sort of mixed message coming through from households when it comes to what they want to do then with their mortgages. You can sort of see the distribution of what people do here. For a period at the start of this year, much greater focus on going short, either floating or 6-month terms. People clearly wanting to get in while they were able to also expect lower interest rates, fix short, get a lower rate sometime soon in the future. Then you came through, you've seen that uncertainty a bit more from households, the concerns around tariffs, the worry around their jobs, the worries around spending, and people have sort of gone a little bit more towards the middle. They've gone to the safe zone of sort of 1 year, where people are often sort of fixing in because it's a bit more of a known sort of option. Not quite as much short fixing, but also nothing going too long either, which I think sort of shows that variety. Also an increased level of anecdata, at least, of people who are splitting their mortgage to sort of have a bit more options, wanting a bit more stability on the repayments because of the uncertainty, but also wanting something maybe a little bit short term so that they can also refix lower if and as interest rates sort of continue to pull back. And with all of that, we've actually been seeing some better spending momentum coming through in the Bay of Plenty. You can see that sort of lift in consumer spending the last couple of months. It's not stopping by any stretch of the imagination. There's still a bit of inflation and pricing pressure that's helping lift those figures. But you can see that after a sort of fairly stagnant period, really, it's been a little bit more of a lift in recent times on the retail trade front. So again, encouraging to sort of see a little bit more of that momentum. Now, that's certainly stronger momentum in spending than what we're seeing at a national level. And I think highlights that, again, with the Bay of Plenty's quite strong primary sector focus and the sort of transport and logistics hub element that comes through, again, just a little bit more to sort of bolster how things are emerging and helping on the jobs front, job ads and everything else too. Let's talk a bit more broadly about the domestic recovery. We've covered some of the pieces, but as highlighted earlier, we really are seeing that primary sector driver coming through. And you can sort of start to see that regionally when you look across the country. Let's start in the South Island, where there has actually been a little bit of jobs growth in the June quarter, a little bit of expansion in Southland and sort of flat tax and the likes of Otago, but then not quite as much of a jobs hit through the rest of the South Island, or in fact through the likes of the Bay of Plenty or the Waikato region through the middle of this year. It's the lower North Island and Auckland that's seen a bit more of a jobs hit, both a combination of drier conditions earlier this year, hitting the primary sector a bit harder in terms of cost, but also a little bit more in terms of, you're seeing some of the horticulture areas doing a little bit better, certainly in terms of where you're seeing kiwi fruit and the likes go. But you've also seen, again, tourism sort of challenges emerge in the North Island, particularly the lower North Island and Auckland, not as much domestic travel, a little bit more coming through in sort of the central or upper North Island piece, and then a lot more international tourism supporting the likes of the South Island too. So mixed bag, but starting to show through various elements of tourism, international and domestic, and some of that sort of primary sector shift as well. That's reinforced that primary sector shift, looking at commodity prices effectively without getting too much into the details. With inflation adjusted commodity prices, we've made them relative to the sort of decade average up until 2024. Anything over 100 means that you're sort of getting better returns, below 100 worse. And you can see there the likes of dairy, horticulture, meat, all in a stronger position. A little bit of an adjustment back in recent times for dairy and horticulture, but that's off some sort of pretty big highs. more just settling into sort of a more, I guess, reasonable range as we've headed into sort of the new season for those products. And again, providing some pretty strong returns, both on a volume and a value basis. The slight pullback in dairy, of course, not as good for farmers directly. Better, though, when it goes to buying butter in recent times. So a little bit more of a mix. Forestry remains in a much tougher place. You can see inflation-adjusted returns for forestry still sort of the worst since the 80s or so. So pretty sort of tough batch more recently for them. Let's turn to construction and the wider housing market for a period here. You can see on this chart internal Infometrics estimates of sort of the components, the underlying demand for construction. You can see the purple line looking at actual consents, and then all the other drivers, population, changes in how many people are living in each household, how old the dwelling stock might be, and how much you might need to adjust it to, upgrade it and what have you, and a few other things besides. For the decade or so after the GFC, you can see that effectively New Zealand wasn't building enough relative to the population and otherwise, and so we sort of built up a bit of a housing undersupply. Then through the pandemic, when the borders were closed, we were building more than we needed to in those couple of years and sort of reducing the previous levels of underbuilding that we did. The last couple of years, we've started to effectively, or we're expecting in the next wee while, to be effectively building more than what we need into the future. That starts to again continue to correct some of that oversupply, but does restrict a little bit just because there's not as much population growth, why you might see building levels go even higher. So trying to find again a bit more of a new normal for where the building and construction market sort of sits as we head forward. One of the challenges, I think, for the New Zealand economy at the moment is that we have, for the first time in quite a while, seen the likes of spending, private consumption, decouple from where house prices go. Previously, other economic times, we've spruiked the housing market up a bit more, had greater house price growth, and that's then led spending activity. Households have felt more wealthy because their house prices have gone up. They've started to spend a bit more money. They've done renovations and everything, and that's helped support the economy. Also, of course, got us into a pretty tough affordability situation. And you can see in more recent times that those two lines have very much decoupled. In the future, we expect fairly flat real house price changes, effectively no real shift, but a bit more of a lift up in private consumption as people are sort of diversifying the sorts of assets that they're holding and where they're putting their money. That does mean a bit of a tougher or slower turnaround in economic activity at the moment, but probably more reasonable in terms of how quickly or how more sustained we can have that economic growth too. And look, we are at Infometrics the lowest house price forecasters in the market. You can see all the other ones here because you shouldn't listen to any one economist and tell you that that's perfect. It's sort of a bit more of a variety show that you should look through. But importantly, you'll see that the Treasury, the government's forecaster, is currently at the top of the picks when it comes to house price growth, despite all the work the government is doing to free up supply and similar. Now, look, in our minds, yes, interest rates are coming down, but to be fair, they've been coming down for a while and they haven't really sort of picked up much in the housing market yet. In fact, we think it's more around the likes of supply of new and existing dwellings into the market and population growth that will dictate things a little bit more. And you can sort of see that here. Population growth across the economy expected to average just 0.6% over the next couple of years, down substantially from where it was, particularly in that sort of post-GFC boom when we did see really strong house price growth. Long story short, it's going to be tough to find lots of new buyers if the population gains are pretty limited across the country. And although you have seen some stronger gains in parts of the Bay of Plenty in the last couple of years, again, there's that real tension between, well, having to have lots of population gain that'll, potentially push up house prices, but eventually you hit a bit of an affordability cap. People aren't able to spend quite as much and therefore don't move to the area, which limits economic capacity in a region. So a little bit of a trade-off that I think you're seeing come through for the Bay of Plenty region. We know that as well, there's already been a bit more of a pullback starting to show through in annual house sales across the country. And I think, again, a little bit of a question over with more houses on the market, with more buildings that are coming through, but also with slower population growth. That's our driver of why we think the number of house sales, the other S, starts to pull back a little bit more. Just again, not quite as many additional buyers in the market. You can see all of this data and some of the data that the TradeMe team have pulled together. You can see on this metric, asking prices are down about 14% from their peak nationally. I'll show you some of the local figures in just a moment. But again, that sort of highlights that with that high level of investment that's been coming through recently, the higher number rather of listings coming through, the investment levels haven't been coming through to quite the same degree. So again, a bit more of a pullback in those prices. Always a bit of a variation depending on the time of year, but again, 14% below peak shows that there's still, people having to be a bit more realistic about what they're selling for. What they were selling for in 2021, not really all that likely to get back to that anytime soon. Market has changed, people's expectations need to adjust as well. And this is really why. You can see here the general and continued lift in the number of listings on TradeMe across the last couple of years. We've turned this into an index to make it a little bit, hopefully, easier to comprehend. Long story short, the average number of listings on site on TradeMe back in the month of September was roughly 24% higher than the average that you saw on the site over the entirety of the 2019 calendar year. So that's quite a big lift in terms of additional options. And that means that from a buyer and seller perspective, there's more sellers that are competing for a smaller pool of buyers. That lower population growth that I told you about before will limit that further. And of course, with still high listings on site at the moment and new builds coming through, again, just having to sort of right size where those opportunities are. I'm not saying by any stretch of the imagination that the housing market isn't going to continue to fire in different ways, but it's not going to be an across the board absolute zoom up. You're going to see a much more sort of greater level of focus, I think, on finding the right property for the right person. And that means that as those in the market, you're going to need to know a lot more to highlight those sort of opportunities, but also challenges to those that you're working with. You see it as well in terms of the averages coming through across different parts of the market. You can see here, I mean, if you exclude the West Coast, which has sort of been a little bit odd at 14% up, very small part of the market, but you sort of see that variation a little bit more through the middle. You can see the Bay of Plenty there ever so slightly back down like about half a percentage point over the sort of last couple of months on average compared to a year ago. But if you look at the other areas in terms of sort of what we're seeing from the regional spread, bit more of a sort of primary sector in South Island touch to a degree in terms of the gains. Yes, I know Otago's up there in a drop. I've averaged these over the last couple of months up until September. There's just a little bit of fluctuation in some of those high-end properties in Otago that have changed the numbers around on this metric. But you look at the likes of the big centres, you look at the likes of Auckland and Wellington, both in decline. Again, a bit tougher with higher supply of listings on site, not quite as much strong buyer demand coming through, just keeping a bit of a cap on prices there for the minute. But you can sort of see the divergence when you sort of look at just the point numbers sort of month to month, and I've sort of a little bit of a shorter time frame there. But you can see the likes of how things have progressed, the likes of Northland and the Bay of Plenty, both sort of dropping through a little bit more through the middle parts of this year, and then a little bit more recovery the last couple of months, a little bit of a pullback in September as a month alone rather than the averaging that I showed you before. But long story short, a little bit more constrained and a little bit more in keeping with that sort of constraint with the national housing market the last wee while. The last couple of months, a little bit more volatile, I think, again, as we're trying to get a read coming into summer of how much you might see a boost or again, how much things might be a little bit more subdued because of those high listings. You compare that to the sort of wider Otago market, stepping out a little bit further, and you can sort of see that gain over time on that sort of longer term trend piece continuing to improve again with, higher demand coming through and again, not quite as much of an increase in supply. The rental market's also shifting quite considerably as well. In general, we're seeing a lot more areas that have actually got lower rents at the moment than they did a year ago. Some areas worse than others. You can see the likes of Gisborne down nearly 10% from a year ago. Of course, they had a real issue with consensus rents rather a couple of years ago. They've now done quite a bit of building, and that's now added enough supply into the market where, again, it's actually a little bit easier to find a rental, which is why you've seen those numbers come back. The likes of Wellington as well, rents down about 8% asking price year on year. And then the likes of Northland and Bay of Plenty, again, you just haven't seen quite the same level of population growth. You have seen more of those properties that are now coming to market because you've seen those higher listings, but not everything's selling immediately because buyers don't want to overpay. You've got a lot of people as well who are saying, you know what, I need to get some money for this rental because I'm just not able to afford paying my mortgage over time and time again. And so again, that sort of dynamics of where the housing market is and how many renters there might be in the area is starting to shift things around a little bit more. Last couple, if I don't address this, it always comes up in the question, so I wanted to sort of front foot this one a bit more. I think it is important to highlight that there is a little bit more of a balanced expectation for the election that will happen roughly, we expect, in a year's time. You can see this sort of coming through a little bit at the moment. We've looked at polling results going back to the 1996 election and what polling was looking like sort of a year ahead of the election, and sort of sometimes it's a little bit more clear cut. You look at likes of the polling results in 98 or even in 07, the opposition at that time was coming through a lot stronger relative to the government numbers. At the moment, a little bit more even Stevens, but you really are just seeing things a little bit more mixed. I think from a government point of view, they clearly are trying to do a lot more investment into the economy. It took a lot longer to get going, but now a lot more shovels in the ground, and so hoping to be able to show a bit more of that delivery as we come through. But look, there's a lot of water still to go under the bridge with politics. We've seen some announcements recently from the opposition parties, sometimes a little bit light on details in some areas, but to be sure, the election campaign has very much kicked off, even if it's been a little bit of a quieter kickoff than otherwise. Where does all of that leave us in general? Well, we still think that economic recovery is coming through. We expect the job numbers to start to improve, that primary sector spending to come through, lower mortgage rates to stimulate a bit more household activity as well. But it has been bitsy. It's been very regional. It's been very industry by industry, and it's taken a lot longer than first expected. We expect, though, from 2026-27 onwards, that economic recovery becomes a little bit less erratic, starting to trend through a little bit more just above that 2% mark as we sort of hit 2027, but it is a slower slog. For the Bay of Plenty, there's, of course, some pretty strong drivers there with the transport and logistics sector, very good primary sector activity coming through, and a lot of building that's happened in previous times, which means that there hasn't been as much intense pressure on the housing market recently. Bit of a double-edged sword. Yep, house prices haven't been rip-roaring like before, but there's also an ability, I think, to have a bit more of an affordability play and attract people into the area to support more sustainable long-term economic growth. With that, I'm going to turn the fire hose off for the moment, and we'll get to a few more questions. We're getting straight into that one. Look, I think there's a question. There's a lot of questions. I think both around what the current government's doing, around what a change in government would do around the whole capital gains tax and similar. I don't see it affecting or influencing the market sort of as strongly as some people are suggesting. And I only say that because realistically, for that capital gains tax coming in, if it came in, it would only influence capital gains or tax capital gains from mid-27 onwards. So realistically, if I've just shown you that there's not a huge amount of capital gains coming through from that period, it's not a lot. You might have held your property for, 30 years, and it might have made huge gains, but nothing changes. None of that is taxable until or ever. It's only whatever would come after sort of mid-2027. So I don't think it will have a huge adjustment. I think it might, at the margin, start to see people invest ever so slightly differently. They'll be looking more at other non-property assets, but more broadly, I think what you're probably going to see is that people are, again, really going to need to get the right property for them. You go back a couple of years, everyone was sort of just piling into the housing market, a little bit carte blanche. Didn't really matter what property you had, it was just good to have one. Whereas I think in the future, and this is where I think the real estate industry can provide a lot more support through to both buyers and sellers of telling them, well, look, is this actually going to be the right property for what you're trying to achieve? Has it got the right sort of markers? Has it got the right yields? Whatever else it might be. But I think it's a lot more specific sort of as we go forward. Oh, not too much. Well, put it this way, it's very hard to find it in the numbers in terms of what the changes have had come through. I think it's a lot more around sentiment. I don't actually know if some of the changes have actually fully entered force, or at least there might have been some that are coming through, but there are more that are emerging from government too. Long story short, it has definitely changed sentiment, particularly that sort of higher end of the market. Some parts, some people I talk to are definitely highlighting they're getting more interest and levels of investment. There's a little bit, I think, that's showing through as well when it comes to some of those regional results. Expectations again that where things are happening in parts of Otago, Central Otago, Queenstown, there seems to be a little bit more interest or activity coming through. So yeah, a little bit. I think it's a lot more on the sentiment side though. It does make sense though. Surely when we're saying to people, look, come to New Zealand and make some pretty big investments, but no, you can't actually live here. Like that was always a bit of a challenging one. So I think that's helpful not only on the housing front point of view, but actually to attract more investment. It gives people a better opportunity to come into the country. Look, there's a lot that comes into the housing supply equation. I think there's various elements of you've got a lot of new builds that have come through in terms of people that have brought things, constructed things the last couple of years. You've also though had a lot of people that bought at various points and now they've been trying to sell. They've been sort of stretched by mortgage affordability. They've been stretched by circumstance. There's always people that have got to change around. They're getting into relationships, they're getting out of relationships, they're having kids or whatever else it might be. So all of that I think has added quite a bit to supply. And the thing that gets me, and the reason I say it's more that than sort of, let's say, purely market-driven forces, is because if it was purely market-driven, you'd expect to see the market at the moment going, well, clearly there's a bit too many houses there. House prices are going sort of more sideways than anything else. I won't list my property. I'll wait until things are better. Yet you're still seeing good, healthy numbers of listings coming forward. And I think what that highlights is that people still need to change around their housing situations every now and then, and that you're seeing a bit of a sort of two-ish markets, maybe a few more than that, but you're seeing sort of much more driven, committed, both buyers and sellers. They're keen to buy something, but also you've got sellers that are going, look, I realize I need to meet the market here and make things work. You've also got a group of people who aren't particularly serious. Let's be blunt. They haven't realized that the housing market's moved on from the peak of 2021. They're not being serious around their expectations, and they're sort of just holding things over. So when you look at some of the movements, there do seem to be some listings, some sales and that take quite a short amount of time. They're sort of pretty lickety split. They've got people that are happy to move on with them, both in terms of buyers and sellers. You've got others where buyers are going, look, I'm not overpaying for property at the moment, and that one just looks a little bit too hard to make it work, so I'm out. But sellers are going, don't you worry, I'm only accepting that one price that I saw a couple of years ago. So I think you're seeing a little bit of that's helping keep those listings and sort of stock on site numbers a little bit higher.
Right, hey, again, thanks very much, mate, for giving up time for the sort of logged in and listen. I hope you've got a few news with vendors and buyers in the month. And all of it on the online Facebook. Everyone, Brad, thanks, mate.
Thank you.